Buying ETFs is easy, but choosing the right one can make a significant impact on your financial wealth in the long run. VOO and SCHD are two popular ETFs in the market. Now the question is, which one is better? In this video, we will compare the composition, historical performance, investment objectives, expense ratio, and the risk of VOO and SCHD side by side. At the end, we will see which ETF will win the 30-year race by investing $100,000 into each fund. Let's see what Vanguard S&P 500 ETF offers. Ticker symbol VOO. It is an exchange-traded fund launched and managed by Vanguard. This fund offers investors exposure to the 500 large companies in the U.S. stock market. All stocks in the fund are large caps in which the market capitalization is over $10 billion, and they are classified as growth and value stocks. VOO is designed to track the return of the S&P 500 index, also known as the market. These companies are well established, and they are the leaders in their respective industries. In the long run, VOO tends to move upwards slowly, just like the S&P 500. This is favorable for long-term investors who are seeking growth with great companies as the economy thrives. Another benefit of investing in VOO is the low cost. The expense ratio is only 0.03% per year. For every $10,000 investment, you would pay $3 per year. Lower fees leave more money in your portfolio. It will help your portfolio grow bigger as time goes. The main sectors are technology, financials, healthcare, and consumer cyclical. Companies like Microsoft, Apple, NVIDIA, and Amazon are the top holdings in the portfolio. They have large capitalizations and have performed very well in recent years. The second ETF is Schwab U.S. Dividend Equity ETF, known as SCHD, has a different investment goal compared to VOO. Instead of focusing on high growth, SCHD invests in high-quality dividend stocks that offer both great dividends and potential for capital appreciation. It tracks the Dow Jones U.S. Dividend 100 Index, which includes companies with a strong history of paying dividends. This strategy aims for two things: dividends and capital appreciation. Owning SCHD is particularly beneficial in the bear market when stock prices plummet because dividends continue to be paid out. In a bull market, SCHD still offers good potential for growth. With the expense ratio of 0.06%, the fund charges $6 per year for a $10,000 investment. SCHD charges more than VOO. The main sectors include financials, healthcare, consumer defensive, and industrials. The investment objective is not quite the same as VOO. Companies like Chevron, Texas Instruments, Lockheed Martin, and PepsiCo are top holdings in the portfolio. These stocks are providing great stability to the fund and paying quality dividends for a long time. Both ETFs are providing different benefits for various investors, with VOO offering exposure to the overall market and SCHD focusing on dividend income along with capital gain. With different investment philosophies, the results are not the same. Now, let's take a look at the performance of VOO and SCHD. Under different market conditions, VOO and SCHD aren't performing the same due to their investment objectives. When the stock market rallies, VOO tends to have significant growth. This is due to the holdings of large cap stocks. These companies are not easy to be manipulated, so the growth potential is there. For SCHD, it has similar performance as VOO during market upswings because stocks in this fund are also large cap. Since SCHD is dividend focused, the growth may not be that high as VOO. But in the downturns, SCHD tends to be less affected by the environment than VOO and still pays dividends. The distinct feature of SCHD is favorable for long-term dividend investors. In tough times, it provides investors dividend income. So, VOO is more volatile in both bear and bull markets, while SCHD has relatively stable performance. In the past 12 months, VOO has returned 24.15% and SCHD has returned only 10.69%. Looking back 10 years, VOO delivered a return of 225.14%, whereas SCHD returned 183.31%. Can we draw the conclusion to say VOO is better than SCHD? Well, it is still too early to do that. These charts only reflect the growth of each fund, but we should consider more factors. There are two types of investing strategies: growth investing and dividend investing. The idea of growth investing is to buy stocks that have very high growth potential in the future, so you will earn the price appreciation. These companies usually focus on development and expansion. They are reinvesting their profits back into the business for things like research and development and opening new markets. So, these companies usually pay very little or no dividends to the stockholders. In fact, Meta has recently started paying 50 cents per share per quarter in dividend. As investors, we benefit from earning high growth by investing in VOO because it holds 500 stocks that have great potential to grow. Investing in 11 sectors that give us exposure to the broader market, including the entire U.S. economy, which closely link to the global landscape. How about dividend investing? This is the idea of buying companies that pay dividends regularly. It is a conservative approach to participate in the stock market growth. No matter what the market does, dividend stocks are providing a passive income periodically. These companies are well established and have track records of commitment to reward stockholders. SCHD holds 100 dividend stocks that performed very well in paying dividends and also have great capital appreciation. These companies are often financially healthy. They may not have very high growth potential, but they have been in the business for a long time and cannot easily be replaced. It is a good choice for dividend investors who do not want to take risks but still have a stream of passive income. When it comes to the cost, VOO has an expense ratio of 0.03%, but SCHD has an expense ratio of 0.06%. Lower expense ratio is always preferred because you want to pay a lower fee to the company to manage the fund for you. It also means you can place more money in your pocket and let it grow. For long-term investors, the growth is significant. Now let's see the dividend yield and the dividend growth. VOO has a dividend yield of 1.37% and the dividend growth rate of 7.14% per year in the past 10 years. These are pretty good numbers for a growth ETF. How about SCHD? The dividend yield is 3.45% and the dividend growth rate of 10.87% per year in the past 10 years. That's very impressive. Despite SCHD charges double of VOO, the dividend increase can easily cover the management fee. From here, we can see SCHD is great for dividend investors. Even if you keep the same number of shares, the dividend growth from year to year is very high. VOO is focusing on growth stocks, so the dividend payout is not as good as SCHD. Let's see how risky these ETFs are. According to Seeking Alpha, the standard deviation of VOO is 13.58 and 13.71 for SCHD. Generally speaking, a higher standard deviation means higher volatility, so the risk is higher. A lower standard deviation means lower volatility, so the risk is lower. So in terms of riskiness, both ETFs are about the same. That also makes sense because both VOO and SCHD are owning large and well-established companies, so their stock prices are relatively stable. Now, let's compare the sectors side by side. VOO owns 30.60% of technology stocks. This is almost a third of the portfolio. Financials, healthcare, and consumer cyclical are about another one-third of the portfolio as well. We can see VOO is tech-heavy. In the current market, tech stocks have higher upward potential than the most. That also explains why the fund has grown very well over the years. On the other hand, SCHD's top 5 sectors are holding almost the same weight in the portfolio, all from 13% to 17%. These sectors have steady growth over the years. This growth may not be impressive, but it is steady and gives investors peace of mind. Both ETFs are not risky. With stocks in different sectors, it greatly reduces the risk of owning either one. Since both ETFs are relatively stable, how about their returns in the long run? Are they about the same? Let's find out. Based on the data from the past, VOO has a dividend yield of 1.37% and the dividend growth rate is 7.14%. The share price appreciation in the past 10 years is 10.49%. Based on the data, a $100,000 investment after 10 years would be $270,476. The annual dividend is $2,727. 20 years later, the portfolio would grow to $793,198. The annual dividend is $5,688. At the 30-year mark, the investment is worth $2,274,245. Now, the annual dividend becomes $11,599. This is equivalent to $967 per month. Pretty good return for VOO. How about SCHD? The dividend yield is 3.45% and the dividend growth rate is 10.87%. In the past 10 years, the share price appreciation is 7.57%. After 10 years, the portfolio would be $266,616 and the annual dividend is $12,320. 20 years later, the investment would grow to $900,249 with $57,556 as annual dividend. After 30 years, the portfolio would be $3,641,752. Now the annual dividend is $322,136. On average, you would receive $26,844 per month. By investing in SCHD until the 30-year mark, your portfolio would have an extra $1,367,507 compared to VOO. Every month on average, your portfolio would have extra $25,878 per month. SCHD has lower share price appreciation than VOO. How can SCHD exceed VOO in the portfolio after 30 years? It is because SCHD has higher dividend yield and higher dividend growth rate. Most importantly, we reinvested dividends in the examples. Dividend reinvestment is also called compounding. That's why Einstein said compounding is the 8th wonder of the world. When evaluating an ETF, we not only need to check the share price appreciation, but also need to consider more factors like composition, historical performance, investment objective, expense ratio, and riskiness. If you choose to reinvest all dividends, the portfolio would grow exponentially in the long run. Thanks for watching. Be sure to hit the like and subscribe button for more helpful tips like this. See you in the next video.